Whether you're a seasoned investor or just starting, real estate can be a fantastic way to build your wealth. In this video, I'll be sharing 4 proven ways to make money with real estate that you can start exploring today. So if you're ready to unlock the secrets of real estate investing, stay tuned. Buying rental properties is one of the most common methods people use to generate income from real estate. The idea here is simple. You purchase a property, whether it's a single-family home, a multifamily unit, or even a commercial property, and rent it out to tenants. This strategy provides a steady cash flow and can serve as a long-term investment. When considering buying rental properties, the first step is to conduct thorough market research. Understand your local real estate market and identify areas with high rental demand. Factors to consider include population growth, employment rates, and proximity to amenities like schools, parks, and shopping centers. These factors can significantly influence the demand for rental properties in a given area. Once you've identified a promising location, it's essential to assess your finances carefully. Determine how much you can afford to invest, including the down payment, closing costs, and expenses related to property management. It's advisable to keep a reserve for unexpected repairs and maintenance costs that may arise. Ensure you have enough cash flow to cover your mortgage, property taxes, insurance, and any other expenses, even if you encounter periods of vacancy. And next, it's crucial to choose the right type of property. Single-family homes are often seen as a good starting point for new investors, as they tend to attract long-term tenants and are generally easier to finance. However, multifamily properties, such as duplexes or triplexes, can provide greater cash flow by allowing you to rent out multiple units. Commercial real estate can also be a lucrative option, but it typically requires more significant investment and management skills. After purchasing the property, effective property management is key to your success. You have 2 choices: manage the property yourself or hire a property management company. Managing the property yourself allows you to save on management fees, but requires time and effort. If you choose to hire a property management company, make sure to select a reputable one that understands the local market and provides good service to tenants. One of the benefits of rental properties is the ability to generate consistent monthly income. If your mortgage payment, plus maintenance and other expenses, is lower than your rental income, you'll enjoy positive cash flow. This income can be reinvested into new properties or other investments. In addition to cash flow, rental properties offer the potential for property appreciation over time. Real estate tends to increase in value, meaning that your initial investment could provide you with substantial returns when you decide to sell. This appreciation is particularly significant in areas that experience rapid growth. Tax advantages are another perk of owning rental properties. Landlords can typically deduct mortgage interest, property depreciation, repairs, and certain expenses associated with rental activities. It's advisable to consult with a tax professional to maximize these benefits and ensure compliance with tax regulations. However, while there is significant profit potential, managing rental properties is not without its challenges. Time management is essential, as you'll need to handle maintenance, repairs, tenant complaints, and lease agreements. Being proactive about addressing issues can help prevent costly repairs down the line. Additionally, consider the possibility of tenant turnover. A vacant property means lost income. To mitigate vacancy risks, conduct thorough tenant screenings, including background and credit checks. Attracting reliable tenants is crucial for maintaining cash flow. Flipping houses is a strategy that involves purchasing properties that are undervalued and in need of repairs or renovations, making improvements, and then selling them for a profit. This method can be highly lucrative, but it also requires a keen eye for potential and a thorough understanding of the real estate market. The first step in flipping houses is identifying the right properties to invest in. Look for homes that are listed below market value, which may be due to various reasons such as outdated designs, minor repairs needed, or even distressed sales. Building relationships with local real estate agents can help you access new listings before they hit the market, and networking with other real estate investors can provide valuable leads on potential flips. Once you've found a property that suits your criteria, it's critical to conduct a detailed analysis of the potential renovation costs and the resale value. This process typically involves getting estimates from contractors, checking for structural issues, and considering the costs of materials and labor. A thorough home inspection can reveal hidden problems that could eat into your profits, so investing in this step is essential. Calculate your potential profit margin by subtracting your projected renovation costs and purchase price from the anticipated selling price. This will give you a clearer picture of whether the project is financially viable. After securing the property, the renovation process begins. Successful house flipping hinges on your ability to manage renovations effectively. It's vital to create a budget and timeline for your project. Begin by prioritizing renovations that provide the most significant return on investment. Typically, kitchen and bathroom upgrades yield the best ROI, as they are crucial selling points for potential buyers. A fresh coat of paint and curb appeal improvements can also make a substantial difference in attracting buyers. During the renovation phase, it's essential to maintain open lines of communication with your contractors. Regularly check in on the progress, ensuring that the work is done according to your standards and within your timeline. Being actively involved allows you to address any issues quickly and avoid costly delays. Additionally, source materials wisely. Establishing relationships with suppliers can lead to discounts, ultimately increasing your profit margins. Another critical aspect of flipping houses is staging the property before listing it for sale. Proper staging makes the house more appealing and can help potential buyers envision themselves living there. Simple touches like decluttering, professional cleaning, and thoughtfully arranging furniture can create a welcoming atmosphere. High-quality photos are crucial for online listings, as they can significantly impact the amount of interest the property receives. Once the renovations are complete and the home is staged, it's time to list the property for sale. Pricing it correctly is vital, as an overpriced home can languish on the market, while a well-priced property can generate multiple offers. Conducting market research to understand pricing in your area is essential. You can also host open houses and leverage social media to promote the property effectively. One of the significant advantages of flipping houses is the potential for quick profits. Unlike traditional rental properties that may require years of management for cash flow, a successful flip can yield returns in a matter of months. However, it's important to remember that the real estate market can be volatile. Changes in market demand, interest rates, or economic conditions can affect your selling price and timeline. Additionally, it's crucial to plan for unexpected costs. Sometimes renovations reveal deeper issues, such as plumbing or electrical problems, that you didn't initially anticipate. Having a contingency fund for unforeseen expenses can help you mitigate financial risks. Failure to plan for these can lead to diminished profits or even financial loss. Real estate investment trusts, commonly known as REITs, provide a unique opportunity for investors looking to enter the real estate market without the hassle of managing physical properties. A REIT is a company that owns, operates, or finances income-producing real estate across a range of property sectors. By pooling capital from multiple investors, these trusts allow individuals to invest in large-scale, income-generating real estate while enjoying similar benefits to direct ownership. REITs are typically categorized into several types, including equity REITs, which own and manage income-generating properties; mortgage REITs, which provide financing for income-producing real estate by purchasing or originating mortgages and mortgage-backed securities; and hybrid REITs, which combine both equity and mortgage investments. Each type of REIT has its characteristics, risks, and rewards, making it crucial for potential investors to understand their options before investing. One of the main advantages of investing in REITs is the liquidity they offer. Unlike traditional real estate investments, which can take time to buy and sell, shares of publicly traded REITs can be bought and sold on major stock exchanges, providing investors with a way to quickly enter or exit their positions. This feature makes REITs a more accessible option for investors who may not have large sums of capital tied up in individual properties. REITs also provide diversification benefits. When you invest in a REIT, you're effectively investing in a portfolio of real estate assets rather than a single property. This diversification helps mitigate risk, since poor performance in one property can be balanced by the performance of others within the trust portfolio. Additionally, REITs often focus on specific sectors, such as residential, commercial, industrial, or healthcare properties, allowing investors to choose REITs that align with their risk tolerance and investment goals. Another significant benefit of REITs is the income potential. By law, REITs must distribute at least 90% of their taxable income to shareholders in the form of dividends. This requirement results in typically high dividend yields compared to other investment vehicles. For investors seeking regular income, REITs can be an attractive option, especially in a low-interest rate environment where traditional fixed-income investments may yield lower returns. However, while investing in REITs has its advantages, there are also risks involved that investors need to be aware of. The performance of REITs can be influenced by various factors, including interest rates, economic conditions, and real estate market trends. For example, rising interest rates can lead to higher borrowing costs for REITs, which may negatively affect their profitability and, in turn, their dividends. Additionally, economic downturns can impact occupancy rates and rental income, leading to reduced cash flow for REITs. Investors should also consider the fees associated with investing in REITs. While publicly traded REITs are typically more cost-effective, non-traded REITs, which are sold through brokers, can come with high fees and commissions that may impact overall returns. It's essential to read the prospectuses and understand all associated costs before investing. For those looking to invest in REITs, conducting thorough research is vital. Focus on the trust management team, performance history, portfolio diversity, and the sectors they invest in. Try to understand their business strategy, particularly how they plan to navigate market changes and what measures are in place to manage risks. Analyzing financial metrics such as funds from operations, FFO, and net asset value, NAV, can provide insights into how well a REIT is performing compared to its peers. Finally, one of the great things about REITs is that they can be incorporated into a broader investment strategy. Many investors opt to combine REITs with other asset classes to create a balanced and diversified portfolio. This approach allows them to hedge against market volatility while still benefiting from the potential appreciation and income from real estate investments. Real estate crowdfunding is an innovative investment method that has gained popularity in recent years. It allows individuals to pool their money to invest in real estate projects, historically accessible only to wealthy investors or through traditional methods. By using online platforms, multiple investors can provide funds for various real estate ventures, including residential, commercial, or industrial properties, making it a democratized way to enter the real estate market. The crowdfunding model operates through a variety of platforms such as Fundrise, Realty Mogul, and CrowdStreet. These platforms serve as intermediaries, connecting developers and project sponsors with potential investors. Investors can browse available projects on these platforms, assess the potential returns and risks, and decide how much to invest. Most platforms offer low minimum investment requirements, making real estate accessible to everyday investors who may not have the capital needed for direct property purchases. One of the main advantages of real estate crowdfunding is diversification. Investors can spread their funds across multiple projects, reducing the risk associated with putting all of their money into a single investment. By investing in different types of properties in various markets, investors can balance their portfolios, potentially leading to more consistent returns. This diversification is especially advantageous in the real estate sector, where market conditions can vary widely from one location to another. Additionally, real estate crowdfunding provides a level of transparency that can be appealing to investors. Many platforms offer detailed reports about the projects, including financial projections, property descriptions, and updates on project progress. This transparency allows investors to make informed decisions based on the information provided by the platform and the project sponsors. While real estate crowdfunding can be a lucrative opportunity, it is not without risks. Investors should remember that real estate projects can be subject to market fluctuations and returns are not guaranteed. The success of the investment depends largely on the project sponsor's experience and the local real estate market's dynamics. Before investing, it's crucial to research the platform, the specific project, and the team's track record behind it. Another consideration is liquidity. Unlike publicly traded REITs, which can be bought and sold on stock exchanges, many real estate's crowdfunding investments involve locking up your money for a specified period, sometimes several years, until the project realizes its gains or is sold. This lack of liquidity can be a disadvantage for investors who may need access to their funds more quickly. Investors should also be aware of the fee structures associated with crowdfunding platforms. While these fees often vary from platform to platform, they typically include origination fees, management fees, and sometimes profit-sharing arrangements that can impact overall returns. Understanding these fees is crucial for assessing the potential profitability of an investment. To enter real estate crowdfunding, potential investors typically need to complete an online registration process on a chosen platform, sign a few legal documents, and in some cases, verify their accreditation status depending on the investment type. Some crowdfunding opportunities are open only to accredited investors who meet specific income and net worth criteria, while others are available to non-accredited investors, broadening access to real estate investment opportunities. It's essential to have a clear investment strategy before diving into real estate crowdfunding. Determine your investment goals, risk tolerance, and the amount of capital you are willing to risk. Some investors may focus on high-risk, high-reward projects, while others might prefer stable, income-producing properties with lower risk profiles. Understanding your investment strategy will guide your project selection and help you achieve your financial objectives. In addition to individual projects, some platforms also offer funds that pool investor capital together to invest in a diversified portfolio of real estate assets managed by the platform. This option can provide even more diversification and reduce individual project risk for investors who prefer a more passive approach to real estate investing. If you found this video helpful, please give it a thumbs up, subscribe to our channel, and hit the notification bell so you won't miss any of our future content. We'd love to hear from you. What strategies have you tried or are interested in? Leave your thoughts and questions in the comments below.